Hey everyone, welcome back to the channel, your number one source for income-oriented investing, how to generate passive income from a diversified portfolio of high-yield funds. And in today's video, I'm going to do a follow-up on my NAV erosion myth video, which got a lot of attention, a lot of back and forth, a lot of comments, almost 14,000 views on that video as I'm filming this. So this is going to be a follow-up video because somebody in our private Facebook group actually made a very interesting post about this video and actually shared his portfolio and has what I think is a very legitimate concern, especially if you're retired or about to retire. And you see a big fluctuation in your capital, right? Your capital is going down. You're getting great income, but your capital is going down significantly. So let me just show you here real quick. I apologize for the transition here. So this is the Facebook post from I was here. So NAV erosion. Thanks for the video, Adriano. I agree with a number of your statements. In that one must look both the NAV and dividends to illustrate the overall performance of a fund, right? However, what if someone is retired and living off the dividends, not able to reinvest? I am sure there are a lot of people in this forum who are retired like me. Thanks to PII. Thank you. However, we are concerned with another topic, capital erosion. I love that he didn't write NAV erosion, he wrote capital erosion. Request, can you make a video on how to manage one's portfolio to minimize capital erosion, please? We can use my portfolio as a start. I would value your input and others to address capital erosion when one is limited in reinvesting dividends. Here is this guy's summary. Initial investment, $1 million 3 years ago. Current portfolio value is $800,000, but current portfolio value, if you include all the dividends he's received in the last 3 years, is 1.1 million, right? So he's basically up $100,000, even though his capital has gone down $200,000, and which is on paper, by the way. Let's just make that clear. It's on paper. It's not realized. So his annual dividend yield is approximately 11%, and he's making about $9,000 a month in income. So he says, because I don't reinvest, I have capital erosion of almost 200K. I agree some of it is due to the bear market, but it's also due to some of the risky funds that I own. What are your thoughts? I would love to see a video. Thanks in advance. So what we're gonna do, guys, is I'm gonna give you 4 of my top tips to try to reduce capital volatility in your portfolio if you're an income investor. Then we're going to take a look at Ivwasir's actual portfolio. He was kind enough to share it with us, and I'll maybe give him just some quick tips right off the bat. And yeah, we'll put this video together with that format. So let's get started. All right, everyone. So I came up with 4 strategies or tips I could give you on how to try to reduce the capital decline in any income portfolio that has very high yield. So most of it has to do with fund selection, obviously, right? Stock selection. So tip number 1 is fund selection, diversified versus niche. So obviously, if you want to try to reduce your capital volatility or the capital amount of your portfolio, I would strongly suggest here to choose more diversified funds over niche funds, right? There's many niche funds out there, and then now there's many diversified funds out there as well. So of course I'm talking about choosing the all-in-ones or the index-based funds over the niche funds, like just the Canadian 6 banks with covered calls, just energy stocks with covered calls, just the gold stocks with covered calls, right? So there's a big difference between the niche funds and the diversified funds. The niche funds are going to have more volatility because it's only one sector, whereas the diversified funds, things like the index-based covered call ETFs, for example, the all-in-ones, HYLD, HDIF, HDIV, you got BMAX now as far as all-in-one. You got even like CNCL, USCL, non-leveraged versions of those. Evolve has those 2 index-based covered call ETFs. Those are going to fluctuate a lot less than niche funds. So that would be my tip number 1. If you're scared of capital volatility, stick more with the diversified funds. Tip number 2 is you have to understand the covered call strategy of each fund and each fund manager, because there's Covered call strategy, the more yield you get, the more aggressive the covered calls are. If they're writing it on more of the portfolio, if they're writing at the money instead of out of the money, right? The more yield you generate, the chances are is that the less upside you're gonna gain when the market or that particular fund goes up, right? It's only normal. So the more yield you get, typically with a covered call strategy, the more upside you are giving up. And the opposite is true also, right? The less covered calls, the less aggressive the strategy, the more upside you're gaining when the market goes up. So remember, covered call strategies, everyone, you're capturing all of the downside, right? If you just have an S&P 500 with covered calls, you're capturing all of the downside of the S&P 500. That income obviously helps as a cushion, right, on your downside, but you're not going to capture all the upside when the S&P 500 goes up. So the degree of upside that you're giving up has everything to do with the covered call strategy. So maybe it's a better idea to incorporate, or a good idea if you're really worried about capital volatility, covered call strategies that are fund managers that are less aggressive. So right away in my mind, BMO comes into my mind, and Brompton. So these are fund managers who have less aggressive covered call strategies. Yes, you're probably going to make less yield, but you'll have more upside when the markets go up, and we know that the markets go up more than they go down, right? So take a look at Brompton, take a look at BMO. They both have all-in-ones now. ZWQT and Brompton has BMAX. Also funds from Mulvihill, yes, they are sector specific and niche. I'm talking about CBNK or XLVE. So these are very unique income enhancing covered call ETFs that focus on the six banks and on healthcare, but you're not giving up any upside. You'll have full upside potential because they only do covered calls on the leveraged portion of the portfolio. You have things like HDIV as well from Hamilton, where they are mixing different covered call ETFs, but there's a portion in there. There's HUTS and HFIN, which don't do covered calls, right? So you have to look at the covered call strategy of the fund manager, maybe incorporating some of these less aggressive covered calls funds that use less covered calls. And yes, you'll probably get less yield, but there's some great options like the Mulvihill ones, for example, or the Brompton and the BMO one. So that's point or suggestion number 2. Suggestion number 3, still with fund selection, is don't hesitate to add non-covered call funds in your portfolio. If you're really worried about capital erosion or volatility over time, you could add non-covered call funds like dividend funds, for example, things like VDY or XEY, which is just all the best dividend stocks in Canada. Another great idea is to allocate a pretty big percentage to EIT.UN, the Canoe EIT Income Fund. So that fund is diversified, does use a little bit of leverage, but it's not a covered call strategy per se. I'm not saying they might not do covered calls. Maybe they can, or maybe they do, but it's more of a organic dividend growth strategy. It's not really a covered call strategy. So that, the proof is in the pudding. If you look at the stock chart, EIT.UN is doing really well, but it's very income oriented. So you can make EIT a bigger percentage of your portfolio, or HDIV again, right? Because there's some non-covered call ETFs in there. There's also leveraged. Hamilton and Horizons has some great leveraged ETFs that don't do covered calls, right? So there's HCAL, for example. There's HUTS that's from Hamilton. So you got the 6 banks, utility companies, enhanced yield because there's 25% leverage, but they don't do any covered calls. So you fully capture the upside and actually gain more on the upside with that 25% leverage. So you're getting enhanced yield, but there's no covered calls. So Horizons also has some great ETFs, and there's more on the way as well where they're leveraged. So you get a little bit more yield, but there's no covered call. So what I'm saying is, you don't have to be exclusively like me, full income oriented. You can have a mix of a few funds that are, maybe dividend focused, or even index funds mixed in with your income portfolio. Yes, you'll probably get less yield overall. There's always that trade-off, right? You'll get a bit less yield, but there's some great options out there. Even MREL is a great option, right? Over 7% yield on REITs, no covered calls. But EIT is definitely one I would strongly probably make a big position in your portfolio if you're really worried about, capital fluctuation. And last but definitely not least, this is probably the most no-brainer one, reinvest a portion of those dividends. So like we saw in that post, he's saying he's not reinvesting it, but actually as a follow-up, and he did a follow-up post and he's saying that now I am reinvesting 20% of my dividends, right? So of course you could reinvest a portion of your dividends. That is the best way to make sure your capital has less volatility over time. If you're reinvesting 5%, 10%, 20, 25% of those dividends every single month, you're helping your capital stay a little bit more. Yes, you're going to get less yield and less money to spend, but it just makes your capital fluctuate less. It increases your capital every single month on the portion you're reinvesting, right? So those are my 4 top tips and suggestions on maybe how to reduce capital volatility of your portfolio if you're an income oriented investor. Fund selection is the most critical thing. You have to understand what you're investing in. Try to go more diversified, less niche. Look at the covered call strategy. Maybe take ones that are less aggressive. Add some non-covered call ETFs in there. Don't be afraid to do that. And a big one is, of course, try to reinvest a portion of it. So now let's take a look at the gentleman's portfolio, and we'll see how we could tips I could give him based on these suggestions here. So here's the portfolio in question, guys, from the guy who posted that. He was kind enough to share his portfolio on Facebook. So let's go through it real quick together here. So you have, a big chunk in EIT, which is great. I'm sure this is one of the ones that's doing really well in his portfolio here. Relatively stable, great income, increased share price as well. Depends when you bought it, of course. BGI.UN, this is a leveraged closed-end fund from Brookfield, which focuses on infrastructure. It's kind of like the Canadian version of RA, the Real Assets Income Fund, which has taken a beating because they reduced their dividend. So this is a little bit more niche. It's a closed-end fund and it is leveraged. So you got to expect more volatility. You have DS and Inc.UN. These are Quadravest's only non-split funds that they have. They're closed-end funds, but they don't have the split share fund structure. So I believe both of them are down right now. But this is closed-end funds has an additional risk where the share price could disconnect greatly from the net asset value. I call it where reality starts disconnecting, right? People start disconnecting from reality. They see it go down. They just start selling it. It's been happening with split share funds. It could happen with closed-end funds as well. And then they start trading at discounts, right? So the worst thing you could do is sell these. Remember what DS is. It's top 15 quality blue chip stocks on the Canadian market. Inc.UN is a collection of all really good financial companies in North America. So I would say hold on to these and maybe get rid of them later. But this is still stock quality, right? You got to look beyond the stock symbol. But these funds, although they don't use leverage here, DS and Inc.UN, there could be more volatility because of the closed-end structure. But the good news is that they still pay you every single month. HDIV, it's a great one to own. Maybe increase the percentage in HDIV because it's not a full covered call product. There's about 20%, 18 to 20% that's a non-covered call product. So it's going to be a little bit, less. There's going to be less fluctuation, or there's less upside given up because of the covered calls. You have ETHY, and if I'm not mistaken, there's also BTCY, so about 5% in Bitcoin and Ether. Obviously, this is extremely niche, very high risk. You got to expect a lot of volatility here, right? The covered calls does help, but come on, these are very niche assets. And hey, I own 10% of these. These are my 2 worst performers just on paper, but I've been adding to them. So I do have HDIF, which is Harvest Great all in one. So these are good ones to increase or make more percentage in your portfolio because they're very, very diversified. Same thing with HYLD. Now you have a bunch of split share funds, which, remember everyone, they're highly, highly leveraged, right? They're much more leveraged than 25%. They're about 50% leverage. So you have BK, RS, SBC, GDV. So GDV is the best global dividend stocks all around the world. BK and SBC is primarily just the 6 banks, which the Canadian banks or Canadian financials, which has been put under pressure. So of course, I'm probably sure he's down heavily on SBC and BK. RS is real estate, a little bit there. Same thing. Real estate has been getting killed. So like he said in his post, some of it is due to market decline. But remember, if you have something that's leveraged, sector specific, that's going down, you're going to expect that they go down very, very hard. CLM, I recently made a video on it on why I got rid of it. it's because I couldn't drip it at NAV. But CLM is basically the whole entire US stock market. It's not a bad fund, and it pays out obviously more than it earns, but you know, you got to count the income. So big percentage in CLM. You got to expect some decline over time with CLM because that is the trade-off with the really high income. RIV and OPP are closed-end funds from NIV River North that have gotten killed in the last 6 months to a year because they're primarily fixed income. They are leveraged. So that combination, fixed income got killed, especially OPP because it has a lot of mortgage-backed securities. RIV got killed as well, not as much as OPP, and also they're leveraged. So of course they're going to go down very hard. It's only normal. You have to remember what you're investing in, but they still pay every month. And once interest rates start getting cut, I'm sure these are going to go recover. So hold on to these. Both of them are trading at big discounts, by the way, right now. OARC, a very niche, higher risk fund here. It's the Yield Max ETF on Kathy Wood's ARC ETF. So obviously you got to expect some volatility. BTCY, we covered that. ENCC, ENS, again, very niche. HMAX, just the 6 banks, you know, similar to BK and SBC, and a little bit in TXF, which is only technology company. So I see a lot of niche funds here, a lot of closed-end funds. Obviously, you know, 3 years ago, I'm assuming a guy who started watching me 3 years ago when we didn't really have all these great leveraged covered call ETFs like we do now. Horizons came out with a bunch of them. But I mean, there is some HYLD, HDIV, you know, HDIV, HDIF, HYLD. So a lot of niche funds. That's obviously going to add to the volatility. My suggestion, go a little bit more diversified. There's no BMAX in here. There's no BMO ones. So I know you're going to get less yield probably, but these are more stable funds. Maybe even bump the EIT percentage up. This is all leverage and covered call stuff. Don't be afraid to add non-covered call stuff in here as well. And really I would maybe start, you know, thinking of what you could sell to go more in the diversified funds instead of the niche funds. There is a lot of niche funds here, but one important lesson, like the guy posted, right? He's down 200K, but he made 300,000. So technically he's up 100,000. So now it's time for my final tips regarding, you know, this portfolio, similar portfolio, and just final tips in general. Let's get that done. So my final tips, you know, regarding the question and the portfolio, even this particular portfolio itself, and people were having this concern. Number one, don't forget that time will always be your friend. The income that you get will always make up for those capital declines, and you will be in a net positive. I've gone through it myself. I showed you my personal example with CLM. I sold that at a $6,000 capital loss, but I've made over $20,000 of income. So this is a net positive. Just like this guy's portfolio, he's down 200K, but he made 300K in income. So time is always your friend with this strategy. This is a reason why I really love this strategy here. Next tip is look beyond the ticker. Okay, there's a lot of, I mean, how could I say this slightly? There's a lot of dumb people out there. That's just the truth, everyone. I see the weirdest things talking about DFN and DGS and split funds or RA or other leverage funds that are taking a beating, or RIV or OPP. They say, this stock is dead. This is a dog. What are you talking about? You got to look beyond the ticker and look what's inside the actual fund, right? So for this example, Inc.UN, he has DS, he has a lot of split funds. What are the stocks inside these funds? You'll most likely see big cap, blue chip, boring dividend stocks. So look beyond the ticker. Investing in DFN or DS or Inc.UN, you're really investing in the stocks inside the portfolio, but the fund manager, you know, the structure of the fund could be a closed-end fund, there could be leverage. That's why it declines very quickly, but then it could go up very quickly. So gotta remember what you're actually investing in. Don't just look online and see, you know, this stock is dead and you sell it off at a loss because you think it's never gonna go up. These people should be ignored. They have no idea. They're amateurs, basically, right? They're thinking like short-term traders when this channel is all about long-term investing, right? So I don't understand why people think short-term, you know, they buy DFN, it goes down 20-30%, and all of a sudden they sell it because they're fed up. They think it's never going to go up again. Are you, I mean, are you okay? So think long-term, not like a short-term trader, which is the mentality that unfortunately most people have, right? They want everything quick and whatever. Next tip is you could modify your portfolio. Don't be afraid to modify your portfolio accordingly. Like I discussed, go into the more diversified funds, go more into the less niche funds. You're just gonna have less volatility. Go into more of the ETFs. You could transition some of your closed-end funds into the ETFs because there's no risk of that NAV disconnecting from the stock price. The structure is a little bit easier to understand and has less risk and less volatility. Take it slow when you're modifying your portfolio and selling your stuff, right? Try to avoid selling at a loss. But I'm assuming, this guy's portfolio, most of his stuff is in a non-registered account because he has a $1 million portfolio. Don't be afraid of realizing some capital losses in your cash account, in your non-registered account, especially if you're an income investor, because remember, those capital losses could be offset with capital gains, including capital gains income, which a lot of these covered call funds give you. So those losses will be eaten up. They will be offset, right? Because a lot of that income you're getting is considered capital gains income. I have the perfect example in 2020. I've realized a $30,000 or $35,000 capital loss from modifying my portfolio. Those losses were completely used up the following year because of all the capital gains income I made. So remember, capital losses, not only can they carry forward indefinitely, which means you'll definitely make up for them, you'll offset them. So it's as if you don't have any capital losses pretty much. You could even carry them backwards for up to 3 years. That's something people don't know. So remember that cash account, non-registered, it's okay to realize losses. Try to avoid it at all costs in your registered account. Last tip, use this as a learning experience. Okay, this is do-it-yourself investing. You're managing your own money, your own portfolio. It takes quite a few years to be the master of your portfolio and be comfortable. Don't just watch a YouTuber like me and copy the portfolio and then just leave it there and get mad after two years that it's not really, your capital's going down. You gotta own your own decisions and make your own decision. This channel is just me showing you how I invest. I'm not recommending you invest this way. I'm showing you my journey and the style I like and that I use, the funds that I like. So use this as a learning experience, right? Like the gentleman's portfolio, the good news is that they're all income oriented funds. He's still getting paid all the time, and time is always going to be your friend. So let's just say he sells off everything right now. He's down 200,000, right? Sells off everything right now. He literally is net because of all the income. He's up 100,000. So he invested $1 million. He's down 800,000. He's down to 800,000, but he made 300,000 in income. So he's technically up 100,000. So it's not the end of the world. Slowly transition, my friend, into the more diversified ETFs. And trust me, everything is going to be fine. Income and time will always be your friend. Look at this as a learning experience. Don't get mad and frustrated, and especially don't give up and just say, oh, this PII is the worst, it sucks. I do see that sometimes. It's pretty comical and funny when you're actually investing mostly in these big blue chip companies with covered calls. You got to look beyond the ticker symbol, like I mentioned. So take your time, take it as a learning experience, modify slowly, accordingly to your needs, and trust me, it takes years before you really master your portfolio. So guys, hopefully this video was useful for you. Let me know your comments or thoughts. I'm sure there's going to be some positive ones and some negative ones, so that's okay. You can leave me let me know what you're thinking, and see you next time. Hey, don't go yet. A few reminders before you leave. Did you know that I launched a YouTube loyalty membership program where for only $3 a month, you could become a PII Inner Circle member, where you will gain access to exclusive content, exclusive videos and live streams, as well as other perks and benefits, including a really cool weekly opportunity report. That's right. If you're interested, just click on the little join button next to the subscribe button to see what it's all about. Also, make sure to follow me on Blossom and download Blossom. It's a social investing app, which is really cool. You could share your portfolio, follow other people's portfolios, including my own. My username is Adrian_PII. So download it with the referral link below. Not only is it free, but you could actually earn cash by taking these really small, quick 1-minute courses. Really awesome. It's a no-brainer. Also, make sure to visit our website, passiveincomeinvesting.ca. That's where you could book a one-on-one private coaching session with yours truly, with myself, where you could ask me all the questions you want All the information and booking information is on the website. Make sure to check out that video on the homepage there to see how to book a one-on-one properly. Also on my website, you could purchase my digital product, which I'm very proud of, the ultimate DIY investing package. This is a reference tool or a companion tool that will help you build your own portfolio. So it has lists of funds, it has sample portfolios, and it covers both the Canadian and US stock markets. And the good news is you'll only ever have to buy it once because it comes with free lifetime updates. And my plan is really to update the version every single year. So make sure to pick it up. Also, I have Questrade and PASSIV referral links below. So Questrade is the broker that I personally use, and PASSIV is the broker companion tool or assistant that I use. Really cool program, really cool software. So I have referral links for both of those. Questrade, $50 of free trades, and PASSIV, I have half off for the elite membership. If you're interested in the elite membership, and even if you want to start out with the free membership and upgrade to the elite afterwards, use my referral code so you could still get that 50% off. And don't forget that the elite membership of PASSIV is 100% free if you use Questrade. For social media, we have a very successful and big Facebook group, private Facebook group with over 14,000 members where we all try to help each other out. So make sure to join that group. Information is below. We also have Instagram where you could follow us or more personal stuff when it comes to our life here in Panama. And there's LinkedIn as well. So as usual, everyone, how do I leave you? Continue to stay safe, stay healthy, and of course, stay passive. See you next time.